Okay, peeps, welcome back. So, today we're going to be talking about the macroeconomic indicators for December of 2023. Is this pullback in stocks going to last for months? Let's get it. So, the first thing that we're looking at here is the SPX. This is always the first thing we go over. You guys know that. So, we got the 50, the 100, the 50 is the yellow one, the 100 is the white one, and the 200 is the red SMA. So as you guys can see here, kind of got a double top here on the S&P 500, and we did get a sell-off from that point. That's not a good sign. So basically, a potential bounce area could be roughly about 4,600. The next support zone is roughly about the yellow EMA and the white EMA, which is, I would say, 4190 to 4320, somewhere in there. And then our major support level is 4020. If we get a close below 4020, I would definitely be sounding the alarm for you guys and be like, hey, we're about to have a serious crash or there's a potential to have one. We will keep you guys updated on that. So with that being said, we're going to get rid of these, get the EMAs back on here. So we'll have two EMAs here. Change this one to 9 and this one to 21. Okay, so we are still above the EMAs, as you guys can see on the S&P 500. That is a good sign. As you guys can see, we broke this downtrend line and closed above the EMAs. Back here in November, as soon as we did that, we had a massive rip to the upside. This thing went up, looks like roughly about from trough to peak, roughly about 10%, which is huge for only a couple month move. So the NASDAQ looking very similar setup here. We're coming down and touching the EMAs. We did kind of more or less get rejected off of this high here. We created like a slightly higher wick, and then we just massively sold off after that point. This could kind of be considered to be a double top, although it's not textbook perfect like the S&P 500 is. I'd say that one was much clearer as to what was going to happen. So this is still resistance until we get a close above it, and the support is roughly between 15,600 and 16,100, and then obviously below that you're taking a look at roughly 14,140 or so. Russell 2000, we got a very clear rejection, immediate sell-off back down below this resistance, what looked like it was going to turn into support but did not. So clearly there was some kind of major bear whale here just manipulating the market and be like, yeah, we're just going to sell off. Just kidding, guys. We're not going up. So that's pretty much what happened there. But the EMAs are still holding the support. As you guys can see, the prices are between 1870 to roughly about 1920 or so. And then we have the trend line below that, which currently sits at roughly about 1770. Dow Jones, which is, I believe, the only indice to have an actual real candle close, new all-time high, did have somewhat of a slight sell-off. So this resistance zone, as far as we know, is now turned into support. So we have one of the four indices at all-time highs. But again, keep in mind the RSI is overbought right now, slightly, not a lot, but last time we saw this, shortly after that, we had a sell-off. It looks like, okay, maybe not shortly. It took like roughly about a year, but we did end up eventually having a sell-off. So just something to keep in mind. But the support zone itself is between 35,600 to 37,100, and the EMAs are between 35,400 to roughly about 36,400. So now we'll take a look at stocks above the 50-day moving average. So the S&P one, as you guys can see here, it looks like we're creating some kind of distribution area here. As you can see, all the wick rejections coming down, trying to push push down out of the sell zone, as we like to call it. Every time we've hit this thing, we've always come back down to the buy zone at some point. Just something to keep in mind there. We are massively overbought at this point. Again, this has only happened a few times throughout the last, I would say, 2-3 years. So we've had looks like 1, 2, 3, 4, 5, 6 times in total since 2020 that we've had this in the last 4 years. So it is a pretty rare occurrence. There could be some buying opportunities, really good buying opportunities coming up ahead. We'll just have to keep a lookout for that. Same thing with the NASDAQ, but it's much more obvious this time. So you have 1, 2, 3, 4, 5, 6 times that we've entered this zone since basically 2020, except this one was much more apparent in its sell off. We basically just got slammed straight back down to the EMAs. At this point, I would say we could push back up into the sell zone, but based on looking at the previous times that we've sold out of this area, I would say that's probably not likely. So could also be getting some good buys on some tech-based stocks too. Now for the 200, we are very clearly in the sell zone on this. This is an even more rare occurrence on the stocks in the NASDAQ and the S&P. As you guys can see here, since basically 2020, we have had one, well, we'll call this whole area here one because this is basically like an entire distribution phase. As you guys can see, it's kind of rolling over. That's a pretty clear sign of a sell-off. So we got 1, 2, 3, 4 times total. Every time it's hit that sell zone, it's always come back down to the buy zone at some point. So it's something to keep in mind. And this is the 200-day moving average is more for long-term investors, whereas the 50-day moving average is more for swing traders or people that are looking for position trades. S&P with the 200, we're not quite at the sell zone yet, but as you guys can see here, when we got to this general area the last 2 times, we did have a sell-off, once in January of last year, once in July of last year. So it's pretty much up or down at this point. We'll just have to see what happens in the following weeks. So the yield curve is the next thing that we'll talk about here. This is not yet uninverted. So we have the 10-year here at 4.05, the 2-year at 4.38. When this thing is normalized, meaning that the 2-year is lower than the 10-year, you would not see this. So definitely something to keep in mind. If the 2-year comes below the 10-year, we're gonna let you guys know because the Fed's looking for the 3-month, or the Fed's looking for the 3-month Treasury rate to come back down below the 10-year. That's their benchmark. So if we see the 210, then basically you can pretty much bet that the Fed's target is about to take place. We're going to get an uninversion, and then could be scary times, but we'll just have to wait and see. We don't think so, but again, we'll keep you guys up to date on that. So the next thing is the Fed funds rate. As you guys can see here, absolutely nothing has changed. They're still holding. They are getting ready to cut, I'm pretty sure. Don't quote me on this, but they did say that they were officially done raising rates on the last FOMC meeting. They had held rates for a long time, but basically said, well, we're going to hold rates, but we might have to raise it just in case inflation gets out of control. So they were kind of trying to scare the markets into thinking they were going to do another rate hike, but they never did, obviously, as you can see on the chart here. But with them coming out and officially saying we are going to officially stop raising rates at this point, and you can see the MACD has also crossed over. And you see that they were holding back here and it crossed over it, and then they started cutting rates after that. So it's pretty obvious what's about to happen. But with them saying it was official, we think that they're going to start cutting rates in March because that would indicate 6 pauses. As you guys can see here, they had 7 on the previous cycle. And then if we go all the way back to 2008, you guys can see that they kind of really overdid it here. They basically had 13 months of pauses. I don't think they should be doing that much. That seems a bit extreme if you ask me, but what do I know? I don't work for the Fed, right? So the next thing is inflation. So inflation's basically headline inflation is at 3.1%. It came down from the previous month slightly, as you guys can see. So we had this little fake out here, and then it came back down. That was mainly because of oil. And core inflation is holding steady at 4%. Again, the Fed's probably looking for it to be roughly, I would say, somewhere between maybe 1%, whereas at an absolute minimum, roughly about 2.5%. But of course, these are lagging indicators. The Fed could start cutting rates and core inflation could still come down. The timing of that on behalf of the Fed has to be absolutely perfect to hit the Goldilocks zone and avoid a recession, so to speak. Unemployment rate, not much has changed here. Again, we've told you guys our stance on this, even though the MACD has crossed bullish, which generally speaking, historically has indicated that the unemployment rate is going to rise. As you guys can see back here, we kind of zoom out a little bit. You guys can see it happened here, and then sometime after that, when unemployment just basically moonshot. We do not want to see that. We want to see unemployment stay relatively flat this entire time. That would be another Goldilocks zone for the Fed and avoiding a recession with them trying to tame inflation. So with that being said, we're going to now take a look at the oil prices. So we'll switch over here to the weekly time frame. And kind of got to zoom out here. Sorry about this, guys, but a lot of these different metrics are on different time frames. So you guys can see we are still in this downtrend based on the MACD RSI. That was the clear sell-off point. We told you guys about that on X. If you've been following us on X, you can see that our timing was almost perfect. It went from $80 down to 68. As of right now, oil is not doing much. It's just kind of bobbing around, but that's good for inflation. We don't want oil to have a resurgence because then headline inflation could pop up again, and that could lead to the Fed raising rates, which could put more pressure on the economy, and we just don't want to see that happen. So I would say oil right now is good where it's at. Now we're going to take a look at the metals. So we'll go over to gold now. So we always do gold on the monthly time frame. Gold's overbought, in my opinion. We're not going to buy it right now. But of course, if you've held gold for a while, you're pretty massively in profit. So you can see our sell zones here between 1920 and 2090, basically, and the buy zone between 1460 to 1366. Silver is kind of stuck in no man's land. It's at $23. Basically, the sell zone is between $38 and $29. The buy zone is between $14.20 and $8.83. Copper is basically a measure of economic growth because copper is used for a lot of industrial purposes. So if we see a sharp sell-off in this, that would obviously not be a good sign for the economy. We have not seen that. But again, it's kind of stuck in no man's land between buy and sell zones. So you got the sell zone being between $4.20 to $5.05 and the buy zone being basically between $2 to $1.35. Palladium, I would say, is the most attractive by far, in my opinion. So your sell zone is between, I'd say, about $34.40 and $30.15 per ounce, and then the buy zone is $11.40 to $8.90. If we get down to this one here, we'll let you know. The last one that we're going to look at is platinum. Platinum, very similar to silver, not doing much. So your sell zone is between $13.20 to $11.70. And your ideal buy zone would be $8.50-ish to roughly about $700 flat. So that covers the metals. Fear and greed index, we could take a look at that real quick. We are obviously, based on pretty much all the indicators that we've showed you, it should be pretty clear that we're in the sell zone or the extreme greed. Okay, maybe not extreme greed, but pretty close, as you guys can see here on the charts. On pretty much almost all of the indicators, we're in greed or extreme greed territory. That calls for a potential reversal of the markets. We have covered Bitcoin. We're not going to cover it in this video because we do that separately. So the next thing that we're going to take a look at is the DXY. So the dollar index is currently kind of sitting roughly in the support zone. What we want to see happen in order for money to flow back into risk on assets is for the dollar to sell off. That would basically mean one of two things. Number one, that people are taking their money out of cash because they believe the Fed has inflation under control. And obviously interest rates are coming down. That's what the market would be convinced of. That's why they would take their money out of cash, because cash no longer produces 4 to 5% savings rates. And they would move that money back into risk on assets. That would be number two, which means stocks and crypto would go up and then the dollar would go down because they have an inverse correlation. So we need to see a break below this trend line firmly and below the support zone and head basically down below 1.00 even to potentially as low as, I'd say, roughly about 95 cents. So now in terms of the VIX, VIX is basically sitting at all-time lows. What we're pretty much looking for here is a massive spike up to anywhere between 38 to potentially as high as 50 and all the way up to potentially 85. If we see that, then clearly there's major selling that's going to be taking place in the markets, but we have not seen anything yet, which is good. But if we do, we'll let you know what's going on with this. It hasn't really done much lately, so it's not much to talk about here. But anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and we'll see y'all later. Peace.